In other words, to fulfill their needs for such information availability. So it involves choice making and knowing when and how to use such information. It has a long history, and our experience with students is that usually they have problems understanding what accounting is and how to go about it. People have the fear that it involves a lot of calculations and therefore it will be of great difficulty to them, but it is not. The approach I'm going to use now is to assume, since I've not come into direct contact with you, I'm going to assume that none of you has done accounting before. So I'm going to start with that assumption and the fundamentals, as the case may be. So the basic objectives of accounting, after telling you what it is, the basic objectives are: one, to make sure whether the business is making profit or loss. Two, to make sure whether the business is worthwhile going forward. Three, to find out what transactions are worth pursuing or recording or recognizing in the business. Three, and perhaps very importantly, to find out how much cash the business has, and deriving from how much cash they have to determine how wealthy the business owners are. To find out whether the business is owed or owing people, and how much. And then finally, to have enough information so that they can keep up-to-date information and knowledge about what is going on generally in the business. People confuse bookkeeping with accounting. So we have to understand that bookkeeping aspect is only one aspect of accounting, and it involves merely the recording of economic transactions, just the mere recording of it. But how to assemble, how to interpret, how to communicate, and how to use said communication for decision making is a package, a whole package, and that goes beyond bookkeeping. So when you talk about bookkeeping and you are referring to accounting as bookkeeping, it is wrong. It is just a small aspect of it. And usually, in practice, we have the clerical staff getting involved with such recording, and we call them bookkeepers. Fundamentally, they are not accountants. Now, who are the users of accounting information? Those who make use of accounting information, we can identify or isolate them as follows. First, those who manage the business. We call them managers. When you get into the MBA program properly, then we shall be talking about management accounting, which has to do with the accounting that deals with the need for accounting information by the managers. So managers are one group of people who need accounting information. The second, the owners of the business. That is to say, those who provide the money or the funds or the assets or the resources that are used to establish the business. Three, the banks. Obviously, the banks are normally established to provide funds to establish businesses. So it is in their interest to know or to have information about such businesses. Then three, those who intend to buy or to invest in the business, not those who already have. Those who, we call them investors. Those who want to invest in the business also have to know what the account information is about the business. Then tax purposes, that is the public. The government needs to know how much the business is making so that they can collect their own by way of taxation appropriately. These are the principal users of accounting information. So we group them into two, basically. Those who use accounting information from the inside perspective of the business, that is the insider use of accounting information, and then the outsider use of accounting information, those who come from outside. And I group them as such. So if you look at the list you have the managers on one hand who form part of the business that are known as the insiders use of accounting information. Then you have the outsiders who are the owners, the banks, the prospective investors, the public, the government. They are outside the business organization. So the two classes of accounting we have, we can break them into two. Accounting information for insider use, accounting information for outsider use. The accounting information for insider use, I've told you already, is the managers, that is management accounting, of which part of which is cost accounting. So we have cost and management accounting on one side, and then accounting information on the other, financial accounting on the other hand. What we'll be concerned about now is financial accounting, fundamentally, to prepare you for management accounting later. So the fundamentals of accounting we are doing now is concerned principally with the principles and everything that has to do with financial accounting. So we are dealing with the outsider use of accounting information. Now, because the outsiders cannot be categorized neatly, because a company doesn't know who the outsiders are, nobody will know them. You cannot identify and know the particular individuals or interest groups outside of the organization who will be using the accounting information. Because of this, it is not possible to deal with them on an individual basis. So what is normally done is to establish rules that will standardize the manner of presenting such accounting information so that anybody outside of the organization that has such information will now know how to adjust the information to suit its own peculiar needs. So financial accounting information is highly regulated or standardized, and it is governed by simple rules like what goes in, what comes in, your debits and your credits, your balance sheets, what is contained on the asset side, what is contained on the liability side, your profit and loss account, your trading account, the items that should belong there, those that should not belong there, our profit is stated, and so on and so on and so forth. We'll talk about later. But right now, it is important to bear in mind. Femi, you have unmuted yourself. Good, thank you. So it is important to realize that if you do financial accounting and you don't follow these simple rules of standardization, you end up causing confusion. The simple way, therefore, to understand what we are about to do is to follow the rules strictly, and we shall be dealing with them step by step. What to do when this thing arises, what not to do, and so on and so forth. And to follow the rules the way I've described it, let us start with a simple statement, accounting equation. This equation is very, very fundamental, and it's a very fundamental rule which everybody has to understand. The rule says that accounting is governed, or all business organizations are governed by resources. What is supplied by the owners of the company and how the company makes use of such resources. So if, for example, the owners supply 100 naira to a company, the company cannot use more than this 100 naira to start the business. So 100 naira coming from outsiders will be the same as the 100 naira which belongs to the company. And such 100 naira can be in many, many forms. It can be cash, it can be in the form of buildings, it can be in the form of land, it can be in the form of raw materials or anything that can be used to run the business successfully. So the value of the resources that can be used to run the business, they cannot be the same. So we said what the outsiders bring should be equal to what the company has. It's a very, very fundamental equation. Translated in another way, what comes from outside the company to help the company start a business is known as capital. What the company uses those resources for is known as assets. So capital is equal to assets. In another way, if you have capital of 100 naira, the asset should be equal to 100 naira. So the capital provided by the company, by the owners of the company, may not be enough to run a business. So as the business grows, it may decide to go and seek help, the creditors and so on and so forth, to add to what the owners have brought. So again, we will have capital plus liabilities, that is loans taken from other sources. Again, these two combined should equal the assets or how those resources are deployed to run the business. Assets are resources. And again, we can group the assets into two. Those that will last long, those that will be consumed within a short period. So we call them long-lived assets and short-term assets. The long-lived assets are called fixed assets. The short-term assets are called current assets. So if you take your mind back, we now have capital and liabilities on one hand, and then we now have fixed and current assets on the other hand. Now, at all times, no matter how complex the business is run, these two fundamental equations must be the same. They can never, one cannot be greater than the other. They have to be the same. So if you go through complex calculations and whatever, these fundamental equations should be the same. And all you do to change them is to add and subtract. To add and subtract as they come in and as they go out. And I'll go through a few things, for example. Let us start with one. If the owner pays in, let's assume that the capital is bringing is purely cash at this early stage. If the owner of the business pays in cash of 100 naira, what effect does it have? One, there will be an increase in the capital the owner has provided. Two, there will be another compensating increase in the cash the company has. If the company keeps this cash in a bank, then bank account will increase and the capital will increase. This will be the effect. One effect will be increase in cash. The second effect will be increase in capital. Now, another, for example, if the business uses part of this money, let's say 50 naira to buy goods, let's say stock, we call them inventory. If the business, let's say at this stage, the owner of the business uses 150 naira to buy inventory, this will have the following effects. One, it will reduce the bank balance by 50 naira, and it will increase assets by 50 naira. In other words, bank cash will reduce, then stock of goods the company has will increase, which will be the inventory will go up. So this time, not two places increasing, but one will come down and one will go up to compensate for the changes. Assuming that the company buys this inventory on credit, this time it didn't pay for it. If it buys on credit, Again, assets will increase, inventory will increase, and then the liability will increase. That liability we call accounts payable or creditors account. This will go up, increase, and then inventory will also increase by the same amount. The second item I'll talk about is assuming the company now sells some of these items on credit. If you make sales on credit, then what it means is that there will be a reduction in the inventory, quantity of inventory it has, and then there will be an increase in the in debtors account. That is those who have bought the goods but have not paid. Again, one asset will go down, one asset will come up. So at all times, things will happen in a company that will result in accounting records being altered or modified to accommodate these changes. Those things that will take place, we call them transactions. Transaction. The notion of transaction is very important. So you ask yourself, what is a transaction? A transaction is an economic event. And without transaction, there will be no accounting records keeping. It's not possible to keep accounting record without a transaction having taken place. And a transaction, which is an economic event, means that it must have value. The transaction has to take place involving naira amount. If you supply goods to somebody, the goods must have value. So if it is 100 naira goods, you cannot say I supply goods of 100 items. No, it must be stated in naira amount. And with this basis transaction, you can now prepare the accounting records. But you know the transaction is not between you and your wife, so to say, or you and your father. So if you tell the person that I've given goods or so and so forth, the person has to take you on trust. No. In accounting, we only recognize those transactions that have been verified with evidence that such transaction has taken place. And those pieces of evidence we need before we recognize a transaction as having taken place are known as the basic documents. They consist of receipts, journals, the liabilities, evidence of somebody owing something, and then when you want to buy something, you prepare inventory of items, and then somebody will sign off. So there will be documented evidence that said transaction has taken place. This is the evidence that will form the basis of the record that will be kept, and it should be filed to support the transaction having taken place. If such evidence is provided, it must be authenticated by another person that the transaction has actually been recognized by the company. So let me go over. I said a transaction is an economic event, and it provides the basis for the accounting record to be kept. Since the transaction will affect the business organization, we started by saying the accounting equation has two sides. So both sides should be recorded or recognized. And one side will affect the assets or liabilities, and one side will affect the owner's interest in the organization. You cannot record one without the other. So once you get the transactions, you must recognize this double effect. And that is what is formed the basis of double entry in accounting. So the double entry is to recognize both sides of the equation, the way I've just described it. And the equation runs through from the first day the transaction has taken place until the very end that the company wants to assemble the information, summarize them, and present them for the record, for information purposes. That is end of year report preparation, and then the government records, filing papers for income tax purposes, as well as getting import license to get goods to run the business. So double entry is simply to recognize the two sides of the transaction that has taken place. I want to be sure that this notion of transaction is clearly understood, because it is so fundamental and important. Nothing happens in accounting without a transaction having taken place. If you come to me by word of mouth that you bought a car for the company, even if you supply the car to the company and we have seen the car, it doesn't make us the owners, it doesn't make the business the owner of the car, as you know. The only thing that will make the business the owner of the car is the document that you have given to the company to show that the papers are in the name of the company, which the company can keep for record purposes. So that document will indicate the value of the car. And it is not the car that is being recorded in the books. It is its value. And as long as the value is recorded, it is supported by evidence that something has taken place. So accounting is really a very interesting thing. It runs through not just businesses, even in your homes. If you stay with your wife and you want to do proper accounting, when you give money to her, it is not just the 100 naira you give to her that should be recognized. You should make her, when he goes to the market, to bring the receipts to show to you that the items he has brought are worth 100 naira. Then if you borrow the money from your friend, you can now show the money, the receipts to your friend, that the reason why you collected the money has been appropriately used for that purpose. Now, the next thing to do is how we are going to handle figures, the actual figures, to reflect this transaction the way I've talked about it. But before then, let's go back to these assets and liabilities I talked about. I said capital plus liabilities equals fixed assets plus current assets. So let's start with capital. Capital consists of what basically the owners of the company have contributed to the business. And for that reason, the capital is supposed to stay in the business for as long as you are running the business. Liabilities, on the other hand, come from those who have lent money to support your business, especially the banks that have provided funds, additional funds, to help you to run the business. Then you deploy this to provide resources for the business. The resources, as I said, consist of two: fixed and long term. The fixed assets, according to accounting definition, are those assets that can stay in the business for at least one accounting period. So what is an accounting period? The accounting period is not 1 year, not 2 years, not 3 years, the way generally understood. But the accounting period is a period which the company itself has adopted to say, at the end of each particular period, we will pause, go back, take a look, and find out how well we have done or how poorly we have done in the form of profit or loss. So the period, the terminal date the company has set for itself to say, this is the time we set to prepare the final account for presentation, is known as an accounting period. Any assets that last for longer than one accounting period is generally known as a fixed asset. Any asset that is consumed within this accounting period, that is less than this accounting period, is known as current assets. And they consist of consumables like raw materials, like goods you buy for sale, or anything, pencils, anything that the company uses to run the business on a day-to-day basis is known as current assets. And the long ones will consist of land, equipment, machine, buildings, and so on and so forth, which will take a longer period. How we recognize this, we'll deal with it later on when we go into more details. At this very, very early stage. I think this is all that I want to talk about by way of general introduction, in order to not to make this thing too difficult. But the accounting equation is what I want you to understand, to get. And then as we move forward, we look at typical transactions, how they affect this equation, and how they are taken care of in the books. Any question, please? You can unmute yourself and ask.
Yes, sir. Good evening, sir.
Yeah.
I want to, you just mentioned land.
Yeah.
Where do we put it? Is it under the current?
No,
Because
land is something, we generally say, let me explain into detail. We generally say that land has no value, except that it takes on its value as it is being used. For example, if you see desert and you decide to put up a building on the desert and the government provides facilities, then the value will increase on its own. So if you put up a factory on a plot of land, the factory stays for as long as, the land stays for as long as the factory is working. So it's a fixed asset. It is there for as long as possible. Hello?
okay, sir. Thank you, sir.
Any other question? Any other question? Please, I don't want you to be be scared. I think as we move along, I will I'll consult the managers and see how I can upload some of these materials to you people so that you can read them. There are so many of them I have. Then they will help you to be reading and update yourself, plus exercises as we move along. Is it accepted?
Yes, sir.
Yes, sir.
Okay. I want any comment, so unmute yourself and ask, and you can comment. You can, at this stage, make any contribution. Mr. Sunday Modo.
I don't have any question for now, sir. No question for now, sir.
Okay. Mr. Joseph Oroku, are there?
No question for now. But let me just make an observation.
Yes, any observation?
Yes. Let me make an observation from the material we have from the school.
Yes. Yes.
The parts that have, let me say, calculations or figures,
yes,
which should be arranged in columns, most of the figures are not properly arranged in columns. So for those of us who don't have any accounting background, we find it difficult to place those figures when we are doing self-study. That has been the challenge I have with the material.
Okay. As I said, I've just done the fundamental introduction now. Just the introduction, just story I've told you now, as of now, since we are not doing face-to-face a meeting. The materials we have will come to it. And I also just said I'll give you alternative materials which may even explain the thing better or correct some of these deficiencies we have talked about. So just give us some time. all these things will be corrected, please.
That will be fine, sir.
Okay.
Thank you.
But hello, Zoroko.
Yes, sir.
As an interest, as a matter of interest, if
Okay.
you can just take us through who are the basic users of accounting information. Can you mention them for me?
Yes, from what I've read, the stakeholders or the owners of the business are part of the accounting, the users of accounting information.
Mm-hmm.
The managers, that's those that take care of the business itself.
Mm-hmm.
The suppliers, those that make supplies to the business, as the case may be, they will need the information from the company to know if the company will be able to pay them and so on. The employees themselves, they are part of the internal stakeholders, like you mentioned earlier. They also need the accounting information to be sure that the company can pay their allowances or benefits. Again, the government, because government require payment of taxes and so on from businesses, so they need to have access to the accounting information from the business. Lenders, those are the banks, they need also to have accounting information to know if the banks can meet up with their commitments.
Yeah.
I think that should be all for now, sir.
Thank you very much.
Thank you, sir.
Thank you very much. Then, Mr. Onyachidoke, are you there?
Yes, sir.
Okay. Please help us with this if you can. We talked about accounting equation, and I tried to explain this in very briefly. Why do you think that capital and liabilities must equal assets of the company?
Why it must equal is that each sides or each sides of the equation must be balanced with respect to input should have a corresponding effect on the output.
Yeah, but why should they be equal? Hello?
Hello, sir. Why?
I said, why must they be equal? Why must the capital and liabilities be equal to the asset? Why must they?
Must they be equal?
Why should they be equal to each other?
For documentation purposes and to know what exactly is going in and what should be expected ideally.
I cannot see the remaining. Chioma Wame, can you help us? Hello, are you there? Okay, Mr. Danny Auditor. Danny Ayele.
Hello, sir.
Yeah, can the auditor, can you help us? Why must capital and liabilities be equal to assets?
Okay, this is David Ayele.
Yes. Okay, David.
Capital is what the companies actually started with, and then the liabilities in case the resources are not enough, the resources that were started are not enough, the company could source for other sources outside, and that comes through as a liability. And so what is being sourced outside, probably from bank as loans, or what is being started with, has to be equal to the assets, because that will show the balancing of what is actually being imputed and then what is actually being utilized by the company.
Come again, I can't hear you properly.
Sorry?
I cannot hear you properly. Yeah. The question I ask is that why must capital and liabilities be always equal to assets?
It has to be equal because for the transactions to be given a proper recording, to avoid losses, to be able to know actually what you have imputed is the same as what is being utilized.
Okay, let me try to explain what I said before. I said capital and liabilities must always be equal to the assets because the company needs resources to operate. The resources come from outside. They are in the form of capital and liabilities. It is these same resources that the company has deployed to acquire resource assets, which it uses to run the business. So he didn't get it from anywhere. It is the resources he gets from outside that he uses to run the business. Nothing more, nothing less. So the resources he gets from outside, which is used to run the business, they have to be equal. If he uses more resources from somewhere, it has not been disclosed. The exact amount of resources he got from outside is what he uses to run the business. So if you take the balance sheet, for example, all resources that come from outside are the same resources which are used to run the business. And they are used to run the business in the form of acquiring assets. So the two have to be the same because no other resources are used to run the business other than what the company has from outside. Simple. So if you add on as the year progresses, whatever is additionally collected is either going to increase or reduce or increase. And I've given you examples of specific transactions to illustrate the point. I think what I would do is that to bring this down home, let me mention a few other transactions, and then I'll throw the question open to see how it will go. Let me ask, is Chioma there?
Yes.
Chioma, is he there?
Yes, good evening.
Okay,
yes.
Let me ask you this question. Let me ask you this question. If the
Okay.
company pays its creditors 1,000 naira,
Okay.
if he pays creditors 1,000 naira, the effect it will have
Okay.
on the company's resources, I want you to describe it for us. What will increase, what will reduce, or what will reduce and reduce? Tell us.
That's if the company pays their the creditors 1,000 naira.
Yes.
Okay, and the liabilities is going to reduce.
Eh?
The liabilities is going to reduce.
Yes.
The liabilities is going to reduce. Then also the assets is also going to reduce.
What type of assets?
That's whatever asset their resources.
What type of resource?
The resource. Cash, like money.
Cash.
Yes.
Uh-huh. Very good. So assuming the cash is now lodged in a bank and the company has to draw on the bank, then it means the bank account balance will reduce, right?
Yes.
Good. And then the liability owing will also reduce.
Reduce. Yes.
Okay. Now, at a later date, a later time when we come to we'll see that when you talk about cash, they appear on one side of the account. The liability appears on one side of the account. So if you now want to reduce what you do, whether you do debit or credit, that is what we are going to talk about later. Because if you want
Okay.
to reduce the balance, you have to debit or credit it. Okay? So in the next meeting, we'll talk about what a recording, what accounting record you should make to give effect for this reduction we have talked about. Is it going to be debit or is it going to be credit? And for a beginner, this thing can be sometimes very confusing. Okay?
Okay. Yes.
Now, let me go back to Mr. Daniel Auditor again. Are you there? Daniel Auditor. Hello? Daniel Auditor, I can't hear you. Okay, Obina Eze. Mr. Obina Eze. Mr. Obina Eze. Mr. Tunde Adeleke. Okay, maybe Mr. David Ayele will talk again. Eh? Okay. Hello. Hello. There's no sound coming out. Eh?
Hello, sir.
Excuse me. David Ayele.
Hello, sir.
Are you there?
Yeah, we are here, sir.
Okay. So if a debtor pays the company money is owing, what effect will it have? What will reduce? What will increase?
Sorry, I can't hear you.
If a debtor, somebody owing the company, pays the company some money, cash, what will increase? What will reduce? What will be the effect?
The asset will the liability will increase. Sorry, the debtor. Sorry. Not quite understood, sir. Sorry.
Should I repeat? Should I repeat?
You repeat, sir.
I said if a debtor pays the company some money, what will increase and what will reduce?
The cash of the company will increase.
Mm-hmm.
That is the current. Should I say the current asset now? That is the asset will increase.
Mm-hmm.
And then the you show that in again. Talking about the other side of the equation now.
Yeah?
the current assets will increase because more cash has come in to the company.
Mm-hmm.
I'm trying to look at the other side of the equation now to balance it up. If somebody can help me out. But I know the current assets definitely will increase because the company has gotten more resources.
What current assets?
The current assets.
Yeah, the cash will increase. Yes.
The cash will increase. Yes, because more resources has come into the company.
So just say more cash.
More cash, yes, has come into the company. If the payment comes in as to probably it's being lodged in the bank account of the company, then the bank account of the company will proportionally increase.
Mm-hmm. Then you have not finished now.
I believe the capital of the company will equally increase too. Am I correct, sir?
I didn't hear. You only mentioned one side. I heard only one side, not the other one.
Yes, it's actually the other
You
side.
said cash will increase.
Yes.
Because more cash will come in. Then what?
Is the other side. I'm trying to look for the appropriate language to use.
Cash will increase, right?
Yes, sir. I'm trying to look at the appropriate language to use to balance the accounting equation.
Okay. Because what you have said, we only said the same one side of the equation, not the other one.
Yes, sir.
Ms. Onyachijoke, can you help?
There will be increase in capital.
Increase in what?
Or rather, the cash that comes in. Then on the other side, which is the asset side, it also leads to an increase too.
An increase. What type of asset?
A current, which is used in the day-to-day running of the company.
What particular type of asset there?
I said current.
No, please. Be specific type of asset.
Okay. I'm lost there.
Okay, since we don't have much time, let me help you. You see,
thank you, sir.
When somebody is owing you, you look at the description of that particular item in your books. You don't call it current assets. That particular item is the person is a debtor to you. So it's either the debtor's account or what the Americans call accounts receivable. That will tell you how much the person is owing you. When the person pays you, your cash will increase. And the amount the person is owing you will come down. It will reduce. Both of these items are on the asset side of the balance sheet. Cash is assets. The person owing you is also an asset since it is an expectation that the money will be paid in future. Both of them are assets. Both of them appear on the asset side of the balance sheet. Both of them are current assets, and they appear on the current assets. They are included in the current asset items in the balance sheet. So the payment will affect both items on the asset side, increasing one and reducing the other one. Some of those transactions will affect liability and assets. Some of them will affect two liabilities. Some of them will affect two assets. Some of them will affect assets and liabilities. the way it is. So in all cases, either one will increase, one will reduce, or the two of them will increase simultaneously. So you look at the thing from that perspective and ask yourself, what item, particular item that is affected? Remembering that the transaction affects two items at all times. You know, a transaction is by definition an economic event, which means it's an exchange process. Two parties are involved, not one party is involved. You cannot give money to yourself. Two parties are involved in tackling all economic transactions. So at all times, you must look at the two sides of the transaction and which items are affected. In your reading, find out particular transactions and how they affect particular items. It can be tricky sometimes, but you know, with a little practice, you can get over it. What I would like you to do is to, I don't know whether you have my, what do you call it, my email address, or however you can ask the coordinator to find out how you can channel any questions directly to me so that I can answer them. All right, this will be all for today. Thank you very much for participating. Huh?
Sorry, sir.
Mm-hmm.
Can you hear me, sir?
Yeah, I can hear you.
In this particular question you asked,
yes,
is it going to affect the accounting equation that is only the asset that is being affected and not the capital or liability side?
Yes, it will affect the accounting equation because both items appear on the asset side, right? Okay. And let's say the asset side are 100, liabilities, 100 capital and liabilities 100, assets 100. They must always remain as 100 at all times. So all these transactions that I mentioned, all that it means is that you are taking 50 naira from an asset side and adding back 50 naira from the same asset side. It will become 100. Right clear?
Okay, sir. Okay, sir.
Okay. All right, good night.
Good night, sir.
Thank you, sir. Good night.
Thank you, sir. Good night, sir.